touched point of control over our heads, 86.56 and 39.05. As I've mentioned before, you can carry forward the value area high and low, especially if they're untouched value areas. I generally don't carry them forward because I've got enough pivots. I don't need those. But if you go and study a volume profile, that's what they're going to teach you to do, is carry them forward. We're talking about distance from moving average, or not being overbought or not being oversold. Here we're looking at the 10-day and how far away from the 10-day the market is. This is an indicator that I built quite a while back to help me kind of gauge each market's reaction to getting too far away from its own 10-period moving average. Think of the 10 like Earth, or say an astronaut bouncing around on the moon. Sure, they're light, they're bouncing around, but there's still enough gravity to keep bringing them back down again. It's very similar to the way the market reacts with its 10-period moving average. It really wants to keep coming back to it. So it will expand beyond it to a point, but that point only carries it so far. And each market has that distance differently. So for an example, the ES may like to stay within a 4% range of the 10 moving average, whereas the NASDAQ might like, say, a 6% range. But what this indicator is showing us is, sure, we're below the 10, just barely, not even a half of a percent, but we're right there. And we have the capacity to move 6% away from the 10, or 3.5% away from the 10. And it wouldn't be extreme at all. So when we think about how far this market could move after today's data, it has the capacity to be a pretty significant move. One of the things that got my attention yesterday was that the VIX woke up. Now, I've been kind of trashing this thing on a day-to-day basis. It's been worthless. It's a piece of junk. All year, it hasn't been any value or use to us whatsoever. So when it actually starts to wake up and move around, it should get your attention, right? Whatever was going on yesterday in that liquidation break, which we know now was a false CPI report. But at the time, we didn't know that, right? We just seen this market start to break support, break through VWAP, and really start picking up speed. And the VIX woke up. So that should have been one of your confirming pieces. Like, is this move going to be sustainable? Is it going to continue to go through the day? And of course, we never know 100% sure. Right? We've seen reactions when the Russian president, when the early part of the war, when he had come in and made some unfounded statements, and the market would react, and then 30 minutes later, it wiped it all back out again. So we never know for sure that a move like this is going to stick through the day. But seeing that confirming signal in the VIX yesterday should have been one more notch that said, yep, this thing is sustaining itself. Bitcoin back above VWAP. I keep seeing calls for Bitcoin to 10K. Now, it's not going to be a straight line. Obviously, it's not going to go straight to 10, but each benchmark, each call out has been hit, from when we were at 50 to 40, when we were 40 to 30, and 30 to 20, and now 20 to 10. You look at the 10-year yesterday and that 1 o'clock auction. I mean, there's really just nothing there, a little bit of reaction right at 1 o'clock, and that was it. And that reaction wasn't shared in the rest of the market. A little bit of volatility was all we got at 1 o'clock. And The only thing that I could say about it is at least everybody was warned to watch out at 1 o'clock. And so that little bit of volatility there, that 15-point move in the ES, shouldn't have caught anybody off by surprise. There was also a pretty rough move in oil yesterday. I mean, it was drastic. Seems like we may have found a temporary bottom at around 94. I don't think we're done with that bottom. We're very likely going to retest it. But my expectations is higher oil, on the year, not maybe necessarily for this week. But I don't think we're done with high prices on energy. And while we may get a double bottom there on that 94 in oil, we may even settle off a little bit lower. A lot of analysts out there are fighting about this. One big name firm is saying oil back to 60, and another big name firm is saying oil to 360. Can imagine what that would look like against the market, right? And then apparently Russia's playing games with the gas pipelines, turning them on and off, and threatening to leave them off. That's going to have all kinds of ramifications, and it's causing a lot of angst in the market. So it's definitely one thing to keep our eyes on as well. Don't forget, you get the 30-year bonds today. It's my day to stream at the Bullish Bears in the futures room, and we had a request to talk about bonds. So we're going to be talking about trading bonds in the futures room today. And double bottom in the Dixie, in the dollar index. The long-term target for the dollar, I think, is around 120. But again, that won't be a straight line. And I think we're more likely to go back to, say, 100 first before we go to 120. But still expected to see 120 with either by the end of this year or within the next 12 months. All right, we still got a lot of compression in Tesla. We were getting these consistently higher lows and lower highs. The other day we did set a higher high, but not by very much. I mean, you almost have to have a stretch of imagination to consider that a good higher high. But we've still got a clearly defined range between, say, below 8 and above 6, or maybe 620 if you want to tighten that up a little bit. And right now we're in the middle of the range. So, today might not be a bad idea to consider starting to build, say, either a strangle, a straddle, or perhaps an iron condor. Maybe put some butterflies on each end of this. The skewed butterfly comes to mind as well, or a broken wing. This won't last forever, right? And the longer we're sideways like this, the more people are going to see it. It's going to self-fulfilling. It's going to break eventually. But might as well get it while the getting is good. There's no, but the room is big enough to run it from the middle to the high or from the middle to the low. But when you try to attempt a directional trade from the middle of the range, there's nothing to lean on. So something to consider, right? Trying to go long from here or trying to go short from here, you're going to want to find something better than the daily. For today, we will be looking for an inside day breakout, a continuation of this last swing high. $695 institutional pivot point, perhaps even 690. So we're looking for a break below that, and we're just looking for a continuation back down to around that 650 level, right? For more of a day trade point of view. Notice how wound up and tight we are here. This is very likely going to also respond to the rest of the market's response on the CPI this morning, but kind of game out. What would a super bullish move in Tesla look like today? Because if the market does turn bullish, it's going to go across all the MOTs, right? All the MOTs. So for Tesla, which has an ADR right now of 5.5, what would a 5.5% move look like from the close today? That's what you want to kind of game out, because these options are not cheap. If you can, say, get some cheaper ones by using some out of the money, then you've got to try to figure out how far out of the money you're going to go. Something like a 5% seems like a good idea. Apple's getting bid up in the pre-market already. Of course, we know that this won't stick. If the CPI is negative, this thing is going down, just like everything else is going to go down. It's had some mixed news in the last few days. Some good, some bad. When it comes to bad news, Google has put on a hiring freeze, I think, or there was some hiring news on Google, which kind of sets the tone for everybody else, because it's been able to avoid a lot of the negative ramifications of all of these rising costs. But now, if it's also getting to the point where it's got to adjust its hiring practices, then that says a lot. So for Apple, we are looking at an R2G carryover. The 11th was the red day. Yesterday was no follow through. Kind of see that rejection off of the 147.5. So we really want to get a nice clean range. All of this is yesterday's range from 148.5 down to 143.5. It's a $5 move. The way to kind of game this out to me is if we can get to the edge due to the CPI on either side, either the edge to the upside, the edge to the downside. If we can get that before 9:30, before the open, then when we come into the open, we break through the edge on either direction and we start to make that extreme move to carry the push beyond the range. Otherwise, we're looking at a base case scenario of us just maintaining inside of yesterday's price action. And when we look at this, that'd be multiple days in a row that we've just been really holding inside of this large range where we got above the 50. We're resting on the 50. We've managed to stay above it and use it as a little bit of support. But today's going to very likely be it's going to settle this one way or the other. From this low down here, we are focused on the swing high, the swing low. We'd be looking for a higher low somewhere in here. And when you put linear regression on it, you realize once we get towards the edges, you got to ask the what's more likely scenario, right? We've already came off of the swing low. We made it to the swing high. What's more likely from here? That we continue to swing even higher, break above 152, this pivot back here, and then we challenge the year-to-date VWAP? Or that we stay sideways, perhaps pull back a little bit into that 140 area and retest the mean. So when it comes to the what more likely scenarios, that linear regression line really helps kind of clean it up. So we talked about Google yesterday. The split is getting closer and closer. It really didn't get the excitement of a split that we would have expected. We got a sideways 50, which doesn't really provide any real comfort or anticipation or expectation of a bounce. These ranges are nice and wide, 2100 to 2400, kind of working our way back down. Yesterday's range was very narrow. So with the CPI today, we're going to be focused on if it's positive, getting back inside the box and then working on 2340 or 2350 to get a topside breakout. Should this continue to carry the negativity from the CPI report, if it happens to be bad and we're still heading to the downside, then target would be 22 and then 21, right? 2150, I don't see much there except perhaps a little speed bump. Microsoft broke angled support yesterday. It gives us like this little micro double bottom. And if we continue with this negativity, then the target's going to be 242.5. Again, I think it's going to be directly related to the CPI numbers today. So if the CPI numbers are negative, then that will be what the target is. Now, they always talk about how a market takes the stairs to go up and jumps out the window to go down. That was a real big move yesterday. We've now got this massive candle. It's going to take days, very likely, to even just try to climb back up to the top of that candle. So if the CPI numbers are not negative today and we manage to open and stay within this candle's low, then it's very likely that this low and this candle's high is going to be our range for at least a week, unless the CPI, of course, is really bad or really good and we start to make some extreme moves. That's not too bad of a range if you're thinking about an iron condor or even a strangle or a straddle. The cost of these options right now may be more than a strangle or a straddle is worth, right? Because the cost of that is going to define where your break evens are. Your break evens might be too far away. $256 right now is the line in the sand. We need to get back above it and start proving that it is our new support. Lots of compression in Amazon too. There was a head and shoulders at the low of this range. And like I had pointed out before, a head and shoulders is something that you want to find at the top of the range, not something that you want to find at the bottom of the range. I had a lot of people asking about this head and shoulders. Was it a head and shoulders? Were they really seeing it? Does it count? It is a head and shoulders, but it was in the wrong location. Now, it doesn't mean that we couldn't get the follow through and that we wouldn't want to measure it and see what our downward projections would be. But we did have to approach it from the idea that it very likely wasn't going to be a head and shoulders with a follow through where we would, draw a line on the neckline and measure head to neck and then plot our downside target. And that's because the head and shoulders isn't supposed to be at the bottom of the range like that. This is a reversal pattern. It's not a continuation pattern. And finding it at the lows and then expecting price to move beyond this even lower would suggest that it is continuing. A head and shoulders is not a continuation pattern. It's a reversal pattern. So I had a lot of people get stuck on this. It is a valid head and shoulders. It is. But we got to learn when to recognize that a pattern doesn't fit in a particular location that we find it in and say, sure, I'm willing to measure it. I'm willing to entertain the idea that we could move in that direction, but it won't be my first argument. It won't be my base case. Sure enough, we bounced when we got back down to those lows, giving us like multiple retests along this bottom. And we did not get the continuation lower. Now it no longer is a head and shoulders. All right, so the head and shoulders is done. That's off the map. We do have compression, however. So lower highs, equal lows. The current low is not marked yet because we have to come off of that low before we can mark this as a higher low. So we can't mark it as a higher low yet. The low isn't done. That gives us lows from here and lows from here, equal lows, lower highs. Again, a market wound up and winding up with more and more energy, getting ready to make a big move. Meta or Facebook, very tight range. If we start with the gap at 176, bring it down to say 155, there's the trash. There's the range that we've been dealing with. And we're basically very close to the middle of that right now. So again, that argument of, well, I want to get a trade and I want some edge in my favor. You try to trade this, you're starting in the middle of the range. That doesn't mean you can't trade it, but you're going to have to go to something beyond the daily to find any kind of edge. Maybe an inside day breakout. We are primed now for an IX10, multiple days in a row inside of this starting candle at 7-11. So should we break below 161.75, then we're going to target the low of this very large candle, 158.43, or at least the open of that candle. 158, I just used the round number, 158. The top side move can also be argued. So if we break above yesterday's highest point or yesterday's open, then we'll have a red to green with an IX10. And our target would be 167.5. If we get above that, start marking the pivots from these 4 candles here, including the very large one at 168.25. The open from 7.7, which was 169.5. I think we'd be stretching the edges of how far we could move in a day on Facebook at that point. I don't see it getting above 170 in a day. Although, it's got a 4% ADR and a 2% market maker move today. So, it has the capacity to do it. There's been a lot of talk about the chips. The chip companies are the short of the year. Everybody's shorting the chips, and there's still a lot of meat on the bones. So, you're looking for swings, then shorts in the chip companies is kind of the trade du jour right now. So what I got, everybody. Be careful, be safe. And I will see you guys in the futures room.